Hello, I'm Cristina Acosta with MoneyWise, and today I'm going to talk to you about two of the most common investments that we see people utilize in their accounts. So one is an exchange traded fund and the other is a mutual fund. Well, the commonality between both of these types of investments is that it allows someone to invest in a diversified portfolio of stocks, bonds, maybe some commodities. So the average exchange traded fund or mutual fund can have, several hundred holdings in them. So they're very diversified. But we often find people don't really have a good understanding of really how they're structured and the primary distinctions between the two. So mutual funds have been around since the 1920s. And they do offer a wide range of options that you can invest in. But one distinguishing factor of a mutual fund is how it's priced on a daily basis and how you can get in and out of a mutual fund. So the two types of mutual funds that are out there that you can invest in, they're called an open-end mutual fund or a closed-end mutual fund. So an open-end mutual fund is a continuous offering. Individuals can buy and sell anytime into an open-end mutual fund. Compared to a closed-end mutual fund is once the amount of shares are sold within that fund, the fund literally closes to new offerings. So the thing to look at on a mutual fund is that if you called your mutual fund company at 9 o'clock in the morning asking them to sell $5,000 worth of shares of that fund, they will not do that until the market closes that day, because each day they have to calculate what's called the NAV, the net asset value of the fund. So they make this calculation every day at the end of the business close to determine the pricing of that fund. So if you did call at 9 o'clock in the morning, you'd have to wait till the market closes and they calculate the net asset value, determine the price of that fund for the day, and to determine how many shares would need to be sold to get you your $5,000. So a limiting factor on that is a lot can change in the market between 9 o'clock in the morning and the time the market closes, okay? So as compared to an exchange traded fund, the uniqueness of an ETF is that it trades just like a stock. So you don't have to wait to have the NAV calculated every day. You can buy in and sell at the current market price. So that is a great advantage, because if you do call at 9 o'clock in the morning, you can sell that fund right then and there at the current pricing. The other advantage of an exchange traded fund is that they're very transparent. They can just track really an exchange. And many of them are just passively managed investments that just track an index like the S&P. So if you're a person that just wants to track a certain index or a certain sector of the market, have very low expenses within the fund, exchange traded funds are something that we encourage a lot of people to look at for themselves and research. So at MoneyWise, we're asked a lot of investment questions, but the primary question we're asked is, will I have enough assets and income when I retire to last as long as I need it to? And will I just be okay at the end of the day? Well, we're here to tell you that you do not need to continue to ask yourself these questions, because we can definitively test this and you will never have to wonder again if you're going to be okay. So we would love to connect with you. Please reach out to our office or connect with us online at moneywiseaz.com.